Good morning and welcome to Market Cafe. You're on ET Now with me, Lisa Fernandez, and with me I have Snehi. Very good morning to you, Snehi. Well, yes, and during the course of the next 1 hour, we take you through what transpired on the international as well as the domestic market. But first, let's start with the international market that Snehi has tracked very closely. Snehi, another day of losses coming in for the US market.
Absolutely, Lisa. So, I think we spoke too soon when we said we can expect a Santa Claus rally. But,
still hoping that December is still not
absolutely,
over.
Christmas is a little far away, so we can still hope for some reversal over here. But, well, let me take you through what Wall Street has done then. And, stock futures have flickered near the flat line on Wednesday night following the 3-day run of losses for the S&P 500 as well as the Dow. Now, the moves follow yet another losing session for the major averages and another signal that late 2023 rally might just be fizzling out a little bit. Now, the Dow and the S&P 500 closed lower for the third straight day, losing 0.2 and 0.4% respectively. Nasdaq has also dropped more than 0.5% in trade as well. The three major indices, however, still remain poised to finish the fourth quarter and calendar year higher. Investors have key data releases to mull over as well. Private payrolls data issued on Wednesday showed that employers added 103,000 positions in November, coming below expectations. We'll also touch upon this in detail a little later in the show as well. The question is whether subsequent data releases this week will show a similar cooling trend. So, well, on Thursday, weekly jobless claims are due before the opening bell in the US, and November non-farm payrolls along with wage data and unemployment rate, all of these will be out tomorrow morning, which is Friday morning in US timings as well. So, well, this is the handover coming in from the US markets. Not much happening, rather subdued moves coming in from the US markets. Let's just focus to European markets, and well, the picture is completely opposite when it comes to European markets, because European markets have closed higher on Wednesday, rebounding from the mixed trading session that was seen earlier in the week for the European markets. Now, the regional stock 600 index also rose by more than 0.5%. It was up 0.6%, and you had mining seeing a sharp turnaround to climb 1.6%. Autos also were up 2.2%. Oil and gas stocks, however, slipped 1%. Now, this is also on the back of WTI hitting levels below $70 per barrel. We'll talk about that as well. Germany's blue chip, the DAX index, nudged slightly higher, extending the record level it closed at Tuesday. So you have DAX at record high levels as well. FTSE also up 0.3%, CAC 40 also up 0.6%. So, well, this is the handover when it comes to the global markets. US bonds also slightly slipped, but still under that 4.1, around that 4.1% mark as we speak. And so, well, this is the handover coming in globally. And Lisa, take us through all the important events that we have to watch out for.
Right, so we spoke too soon on gold prices as well. Good, we didn't stock on it. So yes, gold is seen firming, and this is with treasury yields also, easing. If I look at treasury yield prices now, that treasury yield that's marked at 4.113%, and it stabilized. Gold prices stabilized after a rapid retreat from a record high hit earlier this week. And while investors are bracing for the US jobs report for further clues on how soon the interest rate cuts that may materialize. Well, remember, gold scaled at an all-time peak of around $2,135 per ounce on Monday, and this was on the back of elevated bets for a Fed cut. But even crude prices are seen easing. Crude has Brent crude that has dropped below that $75 per barrel level. Remember, from the September high of $97 per barrel, crude prices have now slipped 23%. But why is the crude prices falling, and what are the implications on the oil companies? Well, we have Somit joining in with more details on this. Good morning, Somit. Take us through this. The oil prices easing of impact.
Well, a couple of reasons for the fresh drop in the Brent crude prices. Firstly is the demand concerns coming out from China, and second is the fact that investors are now doubtful on OPEC plus a successful implementation of this production cuts. Now, because of these two factors, they're expecting the oil market to be in surplus, and hence we are seeing this fresh drop when it comes to Brent crude prices. Now, when it comes to the Indian economy, India imports nearly 85% of their crude requirements, so definitely this will benefit the Indian economy. And as per analysts, every $10 per barrel drop in average crude oil prices deflates the current account deficit by around 14 to 15 billion US dollars, which is nearly 0.4% of the GDP, and it also decreases the retail inflation by around 50 to 60 basis points, and wholesale inflation comes down by around 125 to 135 basis points. But when it comes to companies, a host of sector stand to benefit because of lower crude oil prices. Firstly, when it comes to oil refiners, they are one of the major beneficiaries because lower crude oil prices boost the gross marketing margin that the oil marketing companies earn by selling every liter of petrol and diesel. Now, earlier it stood at around 10 rupees on petrol and 3 rupees on diesel. Now, this would further boost for the oil marketing companies if crude prices continue to remain lower at around $75 per barrel. Now, this will, however, benefit the oil marketing companies only. Now, when it comes to pure play refiners or the standalone refiners like MRPL and Chennai Petro, or for that matter, Reliance Industries also, they would stand to lose because of this sudden drop in crude oil prices, because there would be a significant inventory losses for the pure play refiners. Now, when it comes to oil explorers like ONGC, Oil India, Vedanta and HOEC, now it will be negative for them because crude is the main product, and with lower crude oil prices, their realizations come down, which have a direct implication on their margins and earnings. Now, generally, a $5 per barrel drop in Brent crude prices would impact the EPS of ONGC and Oil India by around 7 to 12%. When it comes to paint companies, it's beneficial because nearly 40% of the raw material cost is either directly or indirectly related to crude derivatives. Aviation companies also stand to benefit because nearly 40% of the total cost is fuel cost, and when crude oil prices come down, the fuel cost also reduces. Apart from that, there is lubricant manufacturers, tire manufacturers, cement companies and a host of specialty companies that tend to benefit because a major part of the raw material cost is either directly or indirectly related to crude oil prices, and whenever crude oil prices come down, their raw material prices also go down, which directly benefits their margins going forward.
Absolutely, Soumi. Thanks so much for taking us through that. A lot of sectors getting affected by all these moves that we're seeing in crude right now. With that, let's also take a look at all the important events that you need to be keeping on your radar today. And let's start by looking at data coming in globally. You've got the US initial jobless claims numbers coming in today. Eurozone GDP data will be out today, as well as China trade data. So I'll keep an eye out on all of these global cues as well. Shifting focus back home then, lock-in period is going to end for Idea Forge Tech as well as Ratnavir Precision today. So both these stocks will be in focus as well. Buyback issue then will be closing for two companies. TCS, that 17,000 crore buyback issue, will be closing today, and also GNFC will have its buyback issue seeing a close today. And in terms of other events then, you've got HAL or Hindustan Aeronautics will be hosting Avionics Expo in Delhi today as well as tomorrow. So I'll keep an eye out on all of these cues.
Well, and on some somber news coming in, the bombing continues across Gaza as Israeli forces move deeper into the region. And for the first time since taking up his post, United Nations Chief Guterres has invoked Article 99 over the war. And the move forces the Security Council to address the offensive, warning it may threaten the maintenance of international peace and security. 16,000 odd Palestinians have been killed in Gaza since October 7th.
Well, in US, private payrolls increased lesser than expected in November as the labor market gradually cools off. Payrolls rose by 103,000 last month, according to the ADP report. Now, remember, the labor market is steadily slowing in the aftermath of 525 bips worth of interest rate hikes from the Federal Reserve since March of last year.
And cryptos have been the talk of the town given the current rally, enabling the assets reclaiming new highs. Now, however, some backlash is coming in for the cryptocurrencies. JP Morgan Chase Jamie Dimon, while speaking at the Capitol Hill in the US, he said that they should be banned.
Well, and following the China downgrade now, Moody's has gone ahead and put Hong Kong, Macau state-owned firms and banks on downgrade warnings. The rating agency said that the moves for Hong Kong and Macau reflected their tight political, institutional as well as economic and financial links with China under their one country, two systems arrangement.
And Google parent Alphabet has introduced its most advanced AI model, Gemini. According to the company, the highly anticipated model is capable of more sophisticated reasoning and understanding information with a greater degree of nuances than Google's prior technology.
Well, keeping it with tech majors, then a US senator has warned that unidentified governments are eyeing smartphone users via their notifications. In a letter to the DOJ, the senator said that the foreign officials have been demanding data from Alphabet's Google as well as Apple.
And the RBI is all set to hold its MPC meet this Friday. The central bank is expected to maintain its status quo on the repo rate. And my colleague Ankur Mishra is here with all the details.
Yes, all important MPC meeting has begun and all eyes will be there whether or not there is a revision on GDP target front, because the rate and stance is expected to remain the same. That is what is anticipated by many economists. But there is a scope of revision in GDP target because the numbers which came for Q2 were 7.2%. It is way above the overall target of Reserve Bank of India of 6.5%. So we need to wait and see whether or not there is a target revision this time. And also on the inflation front, the numbers have come widely within the expected lines of Reserve Bank of India. So we need to wait and see whether or not there is a target revision for CPI as well, because October month numbers were 4.87%, which is very close to the target of 4% mandated for MPC. However, last time Reserve Bank of India governor has said that they will ensure that inflation aligns to the target until that time the war with inflation is not over. Apart from that, the Reserve Bank of India, although watches the domestic numbers only for deciding on the rates, but there will be eyes on US Fed as well, because last time, if you remember the commentary of US Federal Reserve, it was more on the lines that there is a less scope for reduction of rates. So it will be interesting to see that what stance our governor takes on those commentary. And remember, there is a meeting which is scheduled next week of US Federal Reserve. So all these data points will be watched by Reserve Bank of India, and also there may be some announcements outside policy. Remember, last time Reserve Bank of India governor announced about unsecured lending risk part, and later on there were direction for lending institutions for increasing the risk weights.
Alright, Ankur, thanks for taking us through all of those details. Well, all eyes will be on that MPC meet tomorrow. Repo rates are expected to be largely unchanged. With that, let's slip into a very short break. When we return, we'll look at how Asian markets are doing this morning. Hi there, welcome back, and thanks so much for staying tuned to ET Now. This is Market Cafe. Let's talk about some buzz in the auto sector then, because after hitting the global stage, Lamborghini's first in the line of plug-in hybrids, the Ruvelto V12, has come to India. Now, this luxury sports car and Aventador successor is priced at a whopping 8.8 crore rupees ex-showroom. With the 8-speed dual-clutch automatic gearbox, glamorous scissor doors and 3-screen display on the dashboard, it is a sight to see. My colleague Aishwarya Patil was at the launch event and has sent us this report from there. Let's take a look.
Successor, Lamborghini's first in-line plug-in hybrid V12, the Ruvelto V12, is here in India after its global debut earlier this year. Now, this car boasts a lot of things, and speed is just one of them. It can rev up and throttle up to 100 kilometers per hour in just 2.5 seconds, all thanks to the might and power of the V12 6.5 liters engine, which is also backed and supported by the electric motors, as well as a 3 kilowatt hour lithium ion battery pack. Now, that was as far as the engine goes. We see behind us, of course, the iconic scissor doors, which all of us definitely fancy. As far as the interiors are concerned, they've got 3 LED screens, which adds up to infotainment. Now, the first screen is an 8.4-inch vertical touchscreen, a 12.3-inch digital instrument cluster, and a 9.1 passenger side display. What's more, in terms of power, the 8-speed automatic gearbox, which has a dual clutch, that gives you full control and full throttle to the car. In terms of interiors, if we talk about, there are 3 screens given in. First is the 8.4-inch vertical touchscreen that you can see in the center, and you can use that for infotainment purposes. As far as that screen on the other side for the passenger is concerned, that's a 9.1-inch passenger side display, and there is also a 12.3-inch digital instrument cluster display. So the as much as possible in this car you will see less physical buttons. The only controls that you can see will be at the wheel, at the driver's wheel here. So that was about the Ruvelto V12.
You know, the growth for the luxury car market here in India is tremendous. I would say exponential. Okay.
Tremendous and exponential doesn't help to like sort of give some context.
This year, you know, the luxury car market, I mean, the end of last year, the luxury car market went up to more than 500 cars. So it's really becoming bigger and bigger every year. So that's the reason why we believe in the further expansion of the luxury car market in this in India, and that's the reason why we believe in the Lamborghini potential. Again, this trend is supported by a strong growth of the economy, a strong development of the infrastructure, and strong attention of the government in supporting this kind of trend of economy. The market allocation is driven by the demand. So we want to make sure that each market is supplied with one car less than the demand in order to protect our customers and the investment that they are doing in buying a Lamborghini. So having, you know, a high residual value of the cars when again they can be part of a exclusive family like the Lamborghini one.
Well, that was an exciting launch coming in from Lamborghini. But now moving on to an exclusive about Gift City in Gandhinagar. ET now has gathered that there has been a delay in the approvals given to family offices wanting to set up family investment funds out of Gift City. My colleague Bhavya Dua is here with all the details on this. Bhavya?
Right, so the International Financial Services Centre, which is set up in Gift City and which operates the Gift City in Gandhinagar, is yet to approve family investment funds in Gift City. Now, they say that this can be done once overseas investment regulations are amended. IFSCA is in touch with Reserve Bank of India as well as Ministry of Finance, who need to ratify amending offshore investment rules in the country. Now, over 20 applications received by Gift City for these family investment funds are pending with the IFSC authority. Gift City Authority is yet to clear a single family investment fund proposal. Now, these family investment funds were allowed by IFSC regulations in 2022, and some high-profile applicants, for example, Catamaran Ventures of NR Narayan Murthy, as well as Premji Invest of Azim Premji, have put in their applications to set up family investment funds in the Gift City in Gandhinagar. But these applications haven't been passed on or approved by the Gift City Authority as of yet. These family investment funds set up under IFSC fund management regulations, and family offices have attracted various benefits under these IFSC rules, including 100% tax exemption for 10 years within a 15-year period.
Thanks, Bhavya, for all of those details. Meanwhile, the IFSCA chairman K. Rajaraman also said that the two operational international exchanges at Gift City, BSE's India INX and NSE's International Exchange, will be merged by Jan. Listen into what he had to say.
There are two stock exchanges that are getting merged, I think maybe in the next month or so. And this is currently trading on the Nifty which was trading in SGX in Singapore, I think. So this trading now happens in Gift City. But over the next few months, I think direct listing will be enabled. The Honorable Finance Minister also made the statement in July. So I think the regulations are getting notified. I think one of the regulations have been notified. I think maybe in the next few months, the rest of the regulations also will get notified. So direct listing of Indian stocks would happen in Gift City. This will add to the pool of capital, the liquidity and the depth of the market obtains there.
And President of the Confederation of Indian Industry, that is the CII, R. Dinesh, he talks about the resilience of Indian economy amidst the major global headwinds. Now, he also shares his take on the pending repo decision of the MPC and if the elections will bring in more risk to the investments into India. Here's what we got from him.
It has been a perfect year for us, to say the least. considering the kind of overall external environment which we have faced, and also considering that we did have, I would call it, a difficult period we were coming out of, and also the volatility in the overall global market. But having said that, I think the kind of actions which the government had taken in India, especially with regard to both the pillars, which was the ease of doing business and the cost of doing business, and the focus on infrastructure spend, and last but not the least, the digitization journey, which I think the public digital infrastructure as well as the usage by the corporates, I think has made this, I would call it a golden year for us. In fact, CII at the beginning had talked about between 6.5 to 6.7% rate of growth. I'm happy to say that we are now looking at for 23-24 a 6.8% rate of growth, and we also believe that that's something which is sustainable going forward, and we are looking at between around a 7% rate of growth for next year. And most importantly, because of all of these actions which have taken place, I think the eyes of this world have turned onto India, and that places us in a sweet spot for a continued rate of growth going forward as well.
Whether it be manufacturing, whether it be infrastructure, that was the dominant theme for the year gone by. You think in 2024, given that we're stepping into an election year, that will continue to instill momentum to the economy?
So I think the reality is that this government has really been focused on making the right actions for the economy. So if you go back and look at it in 2019 as well, I think when the elections were there had been no change in approach to doing the right things from an economic perspective. So I believe that the continuous focus on capex will continue. And while we may not really have or necessarily need to have the same rate of growth, but as a percentage of GDP, we believe the capex will continue to be focused on from the infrastructure side. But having said that, I think because of this focus on the Indian investment side, I think you will also see that there is a significant level of interest coming from overseas to look at these market and look at our market, not just for the domestic consumption, but also for supporting the infrastructure growth. So I think I don't believe there will be any change in approach at all.
But what about private capex? You think the next phase of expansion will come in not just from government spending, but private capex?
So yes, that's correct. And if you look at from the current feedback we have been having over the last 3 quarters, capacity utilization from the private sector perspective has ranged between 75 to 95%. So in that background, and also we had our recent survey with our members, and we actually heard from them that a majority of them are speaking about increasing their capex investment in H2 as compared with H1 and going forward as well. Therefore, if I compare these two data points and also look at the capacity utilization, I believe that private capex will continue to grow, and the focus will be on supporting and supplementing the government expenditure on infrastructure and investment.
I wanted to understand how critical would the policy response be from the central bank, because while one is anticipating that it's going to be a pause, one is hoping that it will be a shallow rate cut cycle, at least in the second half of the year, if not sooner than that.
Correct. No, I think the Reserve Bank has been, I would say, a standout in terms of managing inflation and growth. And we from CII side actually have supported this policy. They have actually explicitly stated that we are looking at a 4% inflation, and today we are at slightly north of 5%. So if I manage these two, I think a pause would be the right approach. We have actually recommended that it be a pause with a neutral stance, and I would feel that with this kind of growth happening, it will be unfair for us to be looking at any further tinkering with the interest rate right now. So the pause is the best thing which I think we'll be happy with.
Big event, Mr. Ganesh, going into 2024, of course, is the general elections, right? Could that be a risk factor? Because it would surely have its bearing on supply side reforms.
No, actually, if you look at it again from past data, you will actually see that with an election year, that there is, I would call it, significant money supply going up. And therefore, I don't foresee that as a real challenge. And from CII side, like I mentioned, having the ability to have the continuity of the policy of investment in infrastructure and fiscal consolidation is all that we can hope for. So I think for us, we don't see that as a big risk.
All right, that's the word coming in from the CII president. Let's shift focus and talk about a stock that's going to be in focus today, and that's going to be Delta Corp. Because Delta Corp's unit Delta Tech Gaming has secured interim relief from the Calcutta High Court on the 6,384 crore rupees GST notice. The court directs no effect be given to tax authority orders, and the legal battle continues over the alleged tax shortfall spanning from 2017 to 2022.
Right, so Delta Corp will be in focus, and it's been in focus actually since 6 months because it's fallen like more than 40% on the back of these tax issues. But with that, let's slip into a short break and we get back with more stock-specific news post the break. Welcome back to the show, and thank you for staying tuned in. And as promised, we will take you through all the stock-specific action this segment. But that one stock that will be in focus today, it will be Paytm, as it will be on the back of the analyst meet that they held. Well, Paytm will slow down its small-ticket post-paid loans, even as it focuses on the high-ticket personal as well as merchant loans. Now, what else did the company decide in its analyst meet? Gaurav is here to take us through all the key takeaways. Gaurav?
We have some big updates coming in from Paytm. Now Paytm has decided to shuffle their loan book, and according to this, now management has decided that they will reduce the exposure to their small ticket loan book, which is below 50,000 rupees. If you look at the business, around 70% of the postpaid loan book constitutes the loan books which is below 50,000 rupees. Now this move is actually in line with the recent macro trends that we have been seeing in the finance segment, and this is also in line with the view of the lending partners of Paytm. And let's see how it is going to impact the business. Now the management is expecting any kind of downward recalibration in the range of 40 to 50% in the postpaid loan book itself. They also believe that the impact in the 3Q FY23 will be limited, but the impact in 4Q FY23 will be significant from this move, according to the management. Now they also believe that the run rate of the 6,000 crore loan book that we have been seeing in the company will come down almost by 20 to 25%. Somewhere to offset the losses that may incur from this move, the Paytm is now going to focus extend their focus on the high ticket size personal loans as well as the merchant loan book. Now personal loans and merchant loan books have high take rate, and because of this, the revenue impact, the negative revenue impact because of the move is going to get offset according to the management, and the revenues are likely to remain in the same range. They also believe that the margins are also going to remain in the same range that we have seen for the company. They have also mentioned about the concerns that have been going on about their lending partners. Now, Paytm believes that the existing lending partners will continue to support the business, and they are going to continue to add the new banks and NBFCs in their book. And management has also guided that we may see 2 new large NBFCs and 1 new large bank within the next 2 quarters in the business. So all in all, management has been positive on this news and the changes, but let's see how the market reacts, and let's see how the loan book growth will shape up going ahead.
All right, Gaurav, thanks so much for all of those details on Paytm. That stock will be in focus today. Another stock in focus will be mid-cap IT company Mphasis, because they held their management meet, and here are some of the key takeaways from that meet. Now, most headwinds are showing signs of bottoming out, and they haven't lost wallet share in major accounts. They're also among the top 2 vendor partners and in top 5 accounts as well. And well, they plan to replicate success of the company's top 10 accounts as well, and they aim to grow outside of top 10 clients among the US as well as the BFSI space. They say that the Q3 growth is likely to be lower than expectations. Slower deal to revenue conversions are also being seen, and while client pushing for higher furloughs is also taking place as we speak. And seasonal factors are weighing on contribution from Silverline, and growth recovery hinges on improvement in macros. That's the word coming in from the management at Mphasis.
Right, and talking about the broader indices, we have seen a sharp run-up coming in on the broader indices, both the mid-cap as well as small-cap. But now, is there a case to move on to the large caps? Well, listen in to the biggest voices and the experts on what they are advising on the same.
Markets are expensive, there is no doubt about it, from a 12-month perspective. But there are investors who are willing to pay, let's say, take 3 or 4 year view, specifically even the foreign investors who are willing to take 3-4 year view. If I couple that with the certainty of growth in India, right? So then market doesn't look that frothy or that expensive if I take a 3-4 year view. I feel that large caps will also do well here from here on, because if the money comes, which it will, even from the foreigner, given the sentiment and given the overall stability, then the first round of money will come in large cap.
While the small and mid caps in general and the broader markets have done phenomenally well over the last 6-9 months, I think the large caps in general have lagged. And so I think investors want to participate. It's time, in my view, that elephants will dance. So I think there is still an opportunity in the large caps. Not to say that there is no opportunity in the small to mid caps, but I think in a bull market, there's always sector and market cap rotation.
I think large caps will do well, because it is easy for new investors, particularly foreign investors, who are looking at India seriously, not only because India is doing well, but because they are getting bugged out of shape in China. The larger cap financials is the easiest to buy. They're also a large part of the index. So even if these guys underweight, overweight, they still have to put, if not 30-odd%, then 25%, but all that has to go into the same large cap names. And within those three groups, which is financials, consumer, and IT, it is easiest to buy financials because they are doing well and the stock prices have not done well.
General fact that the retailers are making money across all segments. They're not limited only to equity. Gold is doing exceptionally well. Bitcoins are doing fine. Irrespective, housing is doing very well. So generally, there is wealth creation across sectors, which will generally cause greater interest in asset classes, of which equity will also be a part, because you could have a diversified portfolio. The next is the return of FIs, and I think that is going to be a big catalyst for the market. Many people make a statement that the retail is the only element in the market that matters. Retail has caused us to reach where we are. FIs will cause us to move ahead from where we are, because they will now, there's likely to be participation, particularly in the large cap names.
All right, well, that's the word coming in from experts on whether you should move from the broader markets to large caps. But I'm also joined in the studio by my colleague Ansh, who's here to take us through the derivative setup for the day. And Ansh, take it away.
Right, so as you can see in the chart as well, let's get the chart on the screen. Nifty has touched record high for fourth consecutive session. Now, since breaking out from the crucial 980.50 level, Nifty has rallied over 5% in the last 5 to 6 sessions. Let's see what happened in F&O segment. Open interest inched up by around 3%, showing long build-up, whereas on option front, we saw very active call writing at 21,100 strike, indicating traders expecting Nifty to take resistance around this level. Now, the good part is that 21,000 strike price does not have the highest open interest, so touching that psychological mark looks easy now. While on the downside, we saw strong put writing at 20,900, indicating traders may find some good support base here. Shifting our focus to what FIIs did, in index futures, added 12,000 long contracts. They covered around 14,000 short contracts. So net to net, we are seeing a net increase of more than 26,000 contracts on upside, due to which the total long positions has jumped higher to 55%. So finally, bulls are taking the majority in index futures after 2 months now. So in a nutshell, the overall market data paints a positive and bullish picture. Though some consolidation to pause may experience around 21,000 strike, because this is a psychological mark where investors usually do profit booking.
Right, so that was on the F&O snapshot. Thank you for taking us to that, Ansh. But what are the stocks that will be in focus today?
Right, so BEL will be the first stock in focus for today's trading session on the back of an order win. The company has won an order worth rupees 3,915 crore from Indian Army. Brigade will also be in focus as they have signed a joint development agreement for Grade A office space. Outlook Industry has entered into facility agreement with State Bank of India to avail a term loan, whereas Wright has signed an MOU with Meghalaya Industrial Development Corporation to collaborate on a development of multimodal logistic project. Lastly, KT is also in focus as company has evaluated and approved the capacity expansion for its MS gear line. So keep an eye on the stocks.
All right, Ansh, thanks so much for taking us through that list. Lots of stocks to keep your eyes out on in trade today. But with that, I'm afraid we're completely out of time on this edition of Market Cafe. It's a goodbye from Lisa and me, but you stay tuned to the channel because the market takes all the action ahead.